On behalf of Biz Talk Today TV and CrossCheck Media, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and scorching hot Scottsdale, Arizona.
No, it just rained like 2 inches at like 5 minutes ago.
Listen,
I thought the TV was going to be going like this.
Well, when's the last time it rained in Scottsdale, Arizona?
Yesterday.
Yesterday.
You bonehead.
Whatever. Whatever. Well, listen, I know one thing that is not scorching hot, and that is inflation right now, Toby. We had the PPI number that came out today. It was very anemic. We saw an only 0.1% increase. Wall Street economists were predicting a 0.2% increase, of 1% increase, and that is huge because now it leads up into the CPI number coming out tomorrow. Our guest today, though, she is an expert at personal finance, talking economics, monetary policy. She's going to answer all our questions and then some. Welcome, Janet Alvarez. She is joining us on Buy, Hold, Sell today, and she comes to us from SiriusXM Radio. Janet, welcome to the show.
Thank you, guys. Pleasure as always to be here.
Todd doesn't always yell. It's just when a gorgeous female comes on our show, he just can't stop it.
Gorgeous and brilliant.
Yes, he'll be yelling all show, so I'll try to keep it a little lower,
There you go. So listen, Janet, you are interviewing all kinds of A-list people out there, Wall Street politicians, everybody out there. Everyone wants to come to your show, which is on channel 132 on SiriusXM, and we'll plug that a few more times during the show. But Janet, what do you think about this inflation number? Inflation readings are coming down. Yet we start hearing from companies like Home Depot that are telling us that the American consumer actually isn't spending as much as they used to. What gives?
Well, this is a classic slowdown. When you have a decline in inflation, a weakening labor market, a consumer that isn't spending, that sounds like a recession or the classic component of a recession. And actually, if you think about this PPI figure and put it in context, especially against the SOM rule that's been triggered recently and where CPI has been trending over the past 3 or 4 months, we're actually starting to experience something like disinflation. We might be in a position 3, 6, 9 months from now where we might say, prices have come down a little too fast, especially because the last component of CPI that's been holding strong has been housing. And if we see rates coming down in September, like we expect them to, if we get a 50 basis point rate cut, and if the Fed continues cutting sequentially from there, that is going to bring shelter costs down significantly. And that's the last component of CPI that's been holding strong. You might see a CPI figure next year that doesn't even have a 2 handle on it.
Woo. Yeah, I mean, Todd, you gotta take a couple things, into this large picture. Okay. Number one, mortgage rates when they come down means mortgages are lower. And rents typically follow that. It's 41% of the entire CPI is shelter costs.
That's right.
So it's a 4x leveraged to this number. Secondarily, the Fed will tell you, after a couple of cocktails, that the reason why they missed this comeback in inflation is they didn't understand why it went up. I mean, this was all going to be transitory. It was all going to run out, 2 years ago, but it didn't because a lot of this is sticky. And then the third part of what Janet is talking about is, my sort of Johnny one note on this. Remember, the top 20% of households by income are 72% of discretionary spending in the United States. If the bottom half doesn't add any spending, it doesn't matter statistically. What matters is the top 20-25% of households, and they're continuing to spend it at their level. Go try to get a cruise line ship. Try to go fly Delta like I just did to Spain last month. Had the last ticket left. The top 25% is keeping the economy afloat, and that's why we're not going to have a recession. And the Fed will be able to cut rates because it won't be inflationary. All right, thank you very much. I'll be here all week. All right.
Okay. No, I like that, but let me bounce back to that though. If you don't feel that we're going to have a recession, then why cut rates at all?
Well, because the actual neutral rate, in other words, inflation plus interest rate, does affect how borrowing costs and does affect mortgage rates. And I don't want to get into all the details of the neutral, but they need to bring this down so that the economy stays at a growth, not a hyper growth, but not a deflationary standpoint. And again, because housing is such a big part. Remember, Janet, if you looked at for a house recently, I can tell you in the Arizona area, if you want to go 90 miles outside of Phoenix, there's some housing available for you at a reasonable price. But in all these growing central cities, the average starting house in the top 40 cities in the United States is $1 million.
Yeah.
So that is a fact, and therefore people are renting, and there's not enough rental properties to go out. So interest rates have to come down for them to build more rental housing. So it's a positive feedback loop, Todd.
Okay.
One of the things that people frequently forget too is that monetary policy inflates asset prices. So monetary policy impacts the haves, the people who can own assets, the people who own homes, the people who own stocks. They benefit from a decline in interest rates, but it's fiscal policy that benefits the have-nots. So it's when the government starts expanding its largesse that the lower half of income earners in this country see that. So when you start seeing a decline in interest rates, I think it's actually going to be good for asset markets. I think it's going to be good.
Let's talk about that. Let's
Yeah.
talk about that a little bit. So we actually, the month of August has historically not been a great month for the markets, and this month has proven that that is the case. So what do you think, though, going forward? Because obviously, if the Fed's going to be cutting rates, that's going to bring yields down. So therefore, you're going to have to start thinking, okay, let's start going. Equities are going to be the place to be. But what about bonds, though, Janet? Do you see any headwinds or any headwinds ahead on the bond side that maybe investors should be cautious of?
Well, I think so. And especially when you start looking, for example, at the municipal bond sector or lower grade bonds, corporate bonds, I think that there's a lot of risk there. And I've had a lot of guests on my show in recent days basically talking about that risk implicit in the bond market. And there's also all sorts of duration risk. And I think the broader picture, though, is that the bond market, I think, is reverting to something like its norm. And I think when this cycle is done, you're going to see sort of the relationship between equities and bonds renormalize, because it's a relationship that had sort of broken or become untethered over the past couple of years. I think you're going to see that renormalization occur as a consequence of this cycle.
Yeah, I mean, let's not forget that if the Fed rates come down, then mortgage rates come down, which means mortgage bonds go up in value. When interest rates come down, bonds go up in value. Treasury bonds, treasury bills go up in value. And people just haven't seen that for so long. I think they forgot that the bond market, if interest rates come down, the value of the bonds go up. Remember, there was this whole big thing about 4 or 5 months ago that, well, the rich people own all these treasury bills and they're getting 5%, and so they're spending that money, which I sort of laughed at. But there's no question that for the upper 25%, there was a very high correlation of higher income meant higher spending rates. And since they're responsible for the majority of discretionary spending, that makes sense. So, Todd, what I'm worried about, or at least questioning, is when interest rates come down on these bonds, those bonds are going to go up in value. If you sell them and take the profit, when you reinvest it, you're going to be reinvesting at a lower, interest rate. Obviously.
And then, Todd, too, I think longer term, right? We've been in a Goldilocks scenario for the past few years where investors have had it sort of an embarrassment of riches. You can invest in equities and get a nice return. For the first time in many years, you can invest in fixed income and get a nice return.
Yeah.
That's not necessarily going to be the case anymore. With declining interest rates, you're going to see people say, maybe I shouldn't be holding this money in fixed income or in a savings account, and I'm going to throw it at equities, or I'm going to throw it at the housing market. So that's what I mean. I think you're going to start seeing more inflation in those sorts of asset classes as interest rates decline.
Okay, so let's turn the page here on this. And obviously, with the presidential election coming up, we've had a number of guests on Buy, Hold, Sell who have talked about the benefits for the markets going into, at least with an incumbent trying to seek re-election. Now, that's obviously not the case this time.
Way to go, Todd.
Yeah, I know.
Did the carrier pigeon make it to your house? I don't know.
Toby, we were breaking news there. We were breaking news. All right, no. But seriously, though, Janet, what do you think? Because on your show, you've had a number of Democratic governors, Democratic politicians coming on. There seems to be this...
And Republicans.
Okay. There seems to be this but there's this favoritism amongst Wall Street execs, the C-suite level people that are really leaning more towards the Harris Tim Walz ticket. Why do you think that is the case? I mean, are you seeing guests on your show that are maybe giving you a hint of what some of their fiscal policies may be?
I'm not really seeing that. I'm also seeing the tech sector, when you think about like Mark Andreessen and a lot of the big names on the West Coast, making big bets on the Trump Vance ticket. So I think you're starting to see tech, interestingly, become sort of a right-leaning or Republican-leaning sector. Obviously, I think Trump and Vance have made a big play for the tech sector, and of course, Trump having that interview last night with Elon Musk sort of reinforces the sense that there are certain industries like tech that are very Republican-backed. And I think, even JP Morgan's Jamie Dimon was on record a couple months ago saying he didn't think it would be the end of the world if we had a second Trump presidency. He thought it might be good for markets. So I think business people in general, the business community in general, I think is much more evenly split this cycle than in previous cycles. I think you're actually seeing more Republican support from business leaders across various industries this time than you did last time. I think some of that maybe predates the Harris-Walz ticket. I think people were maybe jumping ship when they thought Biden was the candidate. And so they were sort of saying, okay, got to go with Trump. But nonetheless, I think this presidential election cycle has seen, I think, a more even approach towards support for both parties.
Okay.
But I'm so old. I remember, when tech leaders were libertarians. They weren't Democrats. They weren't Republicans. They were libertarians. Leave me the F alone. Let me do my thing. Don't regulate me. And, I'll build trillions of dollars of value. So it was very interesting to me. Obviously JD Vance comes from the venture capital community. There's some other leading venture capital folks that follow Elon Musk, and God knows Elon Musk.
Libertarianism is republicanism now. I mean, there was a time when libertarianism wasn't, but I think by and large, people who are libertarian have all migrated to Texas and they vote Republican now.
Well, if they voted their heart and their politics, they haven't elected anybody in 65 years. So I mean, at some point in time, you got to say, well, okay, Republicans are a little more libertarian than Democrats.
That's good. No, you're right, and that is actually surprising to hear that about the tech sector. But yes, I do know what you're saying, though, Janet, where you had even Zuckerberg was coming out and make positive comments about Trump, especially after the assassination attempt. And then obviously with the interview last night, which I thought was very entertaining. Toby, I'm sure you were listening.
I recorded it. And because I'm not really going to waste my time like putting 45 minutes to listen to those guys. But in hearing it this morning, other than the 20 minutes of effed up, X, I call it Twitter. Okay. I don't care. It's Twitter. It's not X. But Elon realizes that he's got some serious juice. And when you're sort of an egomaniac and you have juice, then you like to sort of use that juice. And for instance, why did they move their headquarters to Texas? Why? Well, because the tax rates are a lot lower, regulations a lot lower. And so once he sort of made that move, I think he, has looked up and said, well, my politics are more aligned with sort of Trumpianism than it is with the more liberal stuff. So it makes good business sense to me.
Listen, I think there's a broad acknowledgement now from the market community that's just implicit in what's happening in the market. There's an acknowledgement that the market's not really going to be influenced that much by whoever's in office, right? I think we've just learned our lesson from history, one, and two, both parties, at least on the fiscal front, are fairly expansionary. So we know that if we get a President Harris or we get a President Trump, they're both going to spend money. And so from the fiscal perspective, which is what they're in charge of, you're going to get something fairly similar in terms of the fiscal spending packages, which is what the market is concerned about.
Todd, remember when conservatives were don't spend money you don't have, people?
Yes.
If you look at Trump's numbers they're talking about an additional $2.5 trillion of unfinanced debt, which that blows me away too. I mean, who do you vote for if you want to actually have your kids have a future and then not inherit by the number of $42 trillion of borrowed money? There's nobody I could vote for that way if I felt that way.
Well, I'm voting for Toby Smith, that's for sure, because I know he's going to invest our tax money into wine, and that's great. That's where the real valuation is going to be. But
go ahead.
No, I was just going to say let's just cut it off on this block, though, guys, because we're definitely going down a rabbit hole, and we don't want to lose the audience. Because coming up next, We're going to put Janet on the hot seat. We got to ask her favorite sectors. And maybe there's a few that she doesn't like, and you're going to hear all about it. She is the inside scoop because she knows everything. She's been talking to all the celebrities from Wall Street, politics, Washington, everybody on her show, which you can catch on SiriusXM channel 132. It is the daily business briefing. You definitely want to catch it. I think is it 9 a.m. or 10 a.m.?
9 a.m. Eastern, 6 Pacific.
9 a.m., 6 o'clock Pacific. You gotta hear it. It's awesome. It's a great show, and it's on daily, which is even better. So listen, coming up after the break, we got Janet coming back. We're going to be right with you. Please stay with us.
Buy, hold, sell, brought to you by CrossCheck Management.
You make me sparkle, you make me tingle, even the stars are brighter when I'm with you. And when I surrender to a tasty kiss or two,
Martini and Rossi iced tea.
you make me sparkle, yes,
Make the moment sparkle.
Welcome back to Buy, Hold, Sell. Well, with us today, we have Janet Alvarez. She is coming to us from SiriusXM. She is the host of the Daily Business Briefing on SiriusXM channel 132. It airs at 9 a.m. every day, Eastern Time. And she's also going to be the host of a new show that we're coming out with on BTT called the oh my goodness, the Money Path. What am I thinking? The Money Path is going to be all about personal finance and also talking about economics as well. And I know we're going to have some great guests on that show as well. You definitely want to catch it. It's going to be launching very soon. So we also have Toby Smith. And Toby, when we left off in the last block, we were going to really put Janet on the hot seat talking about really her favorite sectors. But you came right out. You want to talk about technology. Everybody wants to talk about technology, though. But what are you going to say that's going to be a category killer for the audience?
Well, Todd, thank you for that introduction. I've only done this for 2.5 years with you, so I'm sure nobody knows who I am. The intriguing part of this is about how the algorithmic trading systems are basically running the stock market right now. And you could just look at the 200-day moving average. What we put out to our subscribers the last couple of weeks ago was that if we break sort of the 100-day, then the next support is the 200-day. And in the last 8 times that the technology stocks have gone back to the 200-day, they bounced. And man, they bounced like freaking basketball in the Olympics right off of that 200-day average. So things like NVIDIA, does everyone own NVIDIA? Well, a lot of people sold NVIDIA because they had 3 times the volume they've ever had, during the much needed pullback and the much needed profit taking. But right at that 200-day EMA, baby, came, we were right back in them. And all the technicals are saying that tech going to lead again. Why? Because tech is where the best earnings growth is. And earnings growth is still what makes stocks go up, irrespective of the algo, which was today, I looked, it was 82% of trades on the NASDAQ and NYSE were algorithmic trades.
Okay. So, Janet, what do you think? I mean, you got to be a fan of technology. You work at a company that really is the common denominator is technology with SiriusXM. This show is streamed worldwide, so we're utilizing technology. So just makes sense that we will love the sector. What about you, though? Do you love it as much as Toby?
I'm going to give a very simple response. And that very simple response is the tech is an investment. It's an investment class asset. And the reason that's true, it's because it's the future in every possible sense of the word. These companies are the ones that own the future. If you're not invested in them now, you need to get invested in them. And I'm not sure that I would feel comfortable trading them on a day-to-day basis right now because there's too much volatility around the economic slowdown and the earnings that earning comps, for example, the company like NVIDIA might be facing. It's going to be hard for them to sustain the same level of momentum quarter after quarter after quarter that we've been seeing. And people are going to want to trade around that. But over the long term, if you're a long-term investor, you should absolutely be holding the NVIDIAs of the world, the Mag 7s of the world, because that's where you're going to build wealth over the long term. In terms of other sectors that I like right now, if we're talking about rate cuts, the banking sector is going to be one of the beneficiaries of this, and not just the mega banks that have been having standout quarters anyhow. I mean, Bank of America, JP Morgan Chase, talk about hard comps to beat. They may still beat them anyhow, but the smaller regional banks that had been getting sand in their face over the past couple of years, they're going to be the biggest beneficiaries of this, because all of a sudden, all of those bad loans on their books are going to look a lot healthier, and people are going to want to be taking a look at them. And if you're going to get something like an economic slowdown and the big banks slow on their lending, guess who isn't going to slow down their lending? The small and regional banks, the credit unions. They're going to keep lending. They're going to be viewed a lot more favorably. I would keep an eye on them.
Yeah, I just add that, there's just some mythology. If you want to see who has a lot of office building loans, it's not the regional banks. Bank of America has 4.5% of its loans to, top 20 city office buildings. And those office buildings are not coming back. And, it's going to take a time to convert them to apartments, which is going to be a whole nother business line one of these days soon. But Fifth Third Bank, wonderful bank out of Cincinnati, great balance sheet, great earnings, nice dividend. And Janet's point is well taken. If interest rates come down, then the value of their bond portfolio goes up in value. Therefore, their net asset value goes up. Therefore, they can lend more money. So I'm a big fan. I'm a big fan of Utah National Bank. I'm a big fan of a number of the regionals. The big banks, I think they're sort of priced to perfection here. But man, I love the regional guys, and I love the dividend, and I love the upside.
Yeah, definitely on the regionals. I definitely understand it. Frost Bank out of Texas. They're only in Texas. That's definitely a something to consider. I mean, even M&T Bank that has branches up and down the East Coast. Definitely, and that's really probably one of the heavy hitters for the regional bank side. But I mean, the thing about it though, I think the one issue with that is that now with online banking, like Chase Bank, Chase is they're just taking territory left and right. And they have a lot of accounts that are being opened online, just like Capital One, but they don't necessarily need that brick and mortar store, with the tellers and everything. So I know they're saving money that way, and they wait till there's X amount of new accounts, or at least ones that have accounts in different areas of the country before they move in. So I mean, a bank like I'm surprised that a lot of the bigger banks are not taking over some of these regionals. But then, if that's the case, the regionals, if you think that's going to happen, they would be in play. I know Fifth Third was there was talk of them being taken over a few years ago. And
there's nothing I think that the big banks would want from the regional banks right now, right? Because for the past couple of years, it would just mean assuming bad loans onto their books, and not a very profitable business. And if interest rates start declining, then the big banks themselves are earning more money, and so there's no good reason then buy regional banks that are going to be more expensive on a relative basis.
Well, yeah, I mean, if you look at Chase, Phoenix Scottsdale is a perfect example. They have 3 times as many branches as Bank of America does. Guess what? They have 3 times the amount of deposits or more. The regional vice president is a golf buddy of mine, and I have all my stuff with Chase. They paid me to move my stuff from Bank of America. The personal banker, actually, I know her name, and she calls me if something happens. If you deliver service to high net worth, high income people, then you're going to disproportionately benefit. So I'm a Chase banker, and I'm a Chase stockholder because I've seen what they're doing to kick the heck out of Bank of America, which I don't know. They go to they're the worst customer service I've ever had. So there is opportunity, to grow. And then the other thing is the political side, Todd. These big banks just can't go up and scoop in regional banks. They would, it would not be allowed by the FDIC. So they have to grow.
They probably need to.
Only in a financial crisis, if Powell asks you personally to please bail out a bank. That's the only.
Yes, exactly.
There you go. That's right.
Yeah.
So summertime though, travel and leisure. What do you think of the sector, Janet?
I think the sector is probably overbought right now. I think we're sort of at a multi-year high right now in terms of these prices. The consumer's stretched thin. I'm not sure the comps in subsequent quarters are going to be very healthy in these sectors. So I would generally stay away from consumer stocks and consumer related industries in general over the next few quarters.
Yeah, we have a portfolio we call the affluenza portfolio, and it's
affluenza.
Again, it's all built for the top 20% and really the top 10% of households. Viking is a cruise line that just came public about 4 months ago. We're up about 55% in the thing. It was whoever did the investment banking, like underpriced it like cray. But they're sold out on all of their cruises out and back for the next 3.5 months. So I like Viking. I mean, we took some profits because no shipping company goes up 55% in 2 months. But if you stay in the affluenza part of the world, they're spending like crazy. And if you look at Delta, even though they're crazy thing with CrowdStrike, we bought some more Delta after that pullback because that was insane. I've been on 6 Delta flights in the last 3 months. Everyone's full in first class. Everyone is crowded. And again, if they look at their numbers, they're sold out all the way through October.
Isn't Delta's strategy now to revamp their planes to add extra first class seats? Yeah, they're basically
what American and United, I don't know, for some reason had a brain fart over is they didn't understand that the plane has X amount of seats. When you sell a first class seat for $1,200 and you sell a steerage cabin for $350, it doesn't cost you any more to deliver to get the $1,200, and that's all marginal profit. That's new marginal profit. That's why Delta is kicking butt. American got rid of half of their first class. They wanted to be for the people. Well, that's not how flights in America work.
Well, to United and American's credit, they were responding to pandemic-related travel patterns.
Yeah.
Right. So then when they revamped their planes, unfortunately, it was during the pandemic and immediately post-pandemic as a way to slash costs and make seats more affordable to bring people out to travel. But now that they revamped their planes, they're kind of in a hard spot. What do you do? Refurbish them again?
Yeah, you have two 747s. One has 250 seats that are custom class or first class. The other ones have 95. Yeah. 80 or 90% of the profit of that route, all the guys in the back pay for the gas and the help and the pilots. 100% of or 92% of the profit is up front. And by giving away 50% of the upfront stuff, they, as you say, basically screw themselves. Although if you go in Emirates, Todd, let me say that right now. If they were a public company, I would own Emirates. Because when you fly Emirates, it doesn't matter whether you're first class or steerage class. When you walk in, the first thing they say is, "Would you like some champagne?" "Yes, I would. Thank you very much." Then they bring you a bottle of Dom Perignon. I mean,
it's like visiting your household. Yes, absolutely.
Exactly. Yeah.
Janet, what about the with the baby boomer sector with Toby's generation? What do you think about healthcare?
I like healthcare. I love healthcare. And that was the other sector I was going to mention. I mean, obviously you have all of these weight loss drugs that are making Eli Lilly billions and billions of dollars and just transforming the healthcare industry in general. But you're right. I mean, just the general demographics of aging and so forth. And whoever's in power, they're going to have to do something about entitlements. They're going to have to do something to ensure that people can afford healthcare. I just don't see how healthcare gets squeezed in any meaningful way, even if entitlements are squeezed, even if the Biden administration succeeds in lowering the cost and negotiating lower costs for a lot of drugs. This is just a sector that's primed for continued growth. And also, I think just biotech in general has been accelerating in terms of its rate of development over the past couple of years. This is something that's been kind of quietly happening. A lot of the developments that we got in antivirals and so forth that were developed during the COVID pandemic are now being repurposed for all other types of illnesses. So now you have a lot of the innovations that we got from the COVID pandemic being applied to cancers and being applied to immune disorders. This is just an explosion in biotech that's happening right beneath the surface because everyone's paying attention to the Magnificent Seven. They're not paying attention to what's going on with the biotech explosion, which I think is primed for growth.
Yeah, I mean, so I'm full disclosure, I'm on the board of directors of 2 biotech companies, so I'm sort of like biotech. Mm-hmm. But if you look at what's happened in the last 2 weeks, just Wall Street Journal, the last 5 days, the large pharma companies are pulling back on new acquisitions and on new research. Guess why? Because out of 100 new drugs that go into the FDA system, only 2 get through it. 98% failure rate to get approved. They spend on average $2 billion. And it's now, they finally dawned on them that, gee, we don't need these 2,200 research scientists if we're going to fail 98% of the time versus buying a biotech company that's, through stage 2 of really good numbers. And so that's what big pharma at the top is doing. The other thing is big pharma has a number of big drugs that are coming off patent in the next 24 months. So I'm thoroughly with you. I say I'm on the board of one public and one private biotech companies, and I'm the one who gets the first inquiry as if they're interested. And we used to say, yeah, nice knowing you. Now we say, bring it on, because if you pay us $2 or $3 billion for our company, then I'll be doing this from my 747, just flying around the world, and so that's really my main goal. But I'm facetious. But biotech, small with great technology, are not cutting back research. They're actually expanding research. Big pharma is cutting back. We just saw yesterday Bristol Myers 14%. A variety of other mega guys, because it doesn't pay to do the research if you fail 98% of the time. I don't know if you know how that math works, Todd, but I'm telling you, it doesn't work.
No, I definitely understand that. So listen, Janet, we have to leave it there. Toby, both of you said so much. Janet, with the disinflation comment earlier, that's going to definitely be our promo piece for this show. So that was fantastic. And you can hear more from Janet Alvarez. Just go to SiriusXM channel 132. Listen to her daily at 9 a.m. Eastern time on the Daily Business Briefing. And she has all the A-list Wall Street celebs as well as politicians from Washington talking everything about the markets as well as monetary policy. So it's definitely a must-listen to show. So on behalf of Janet Alvarez and Tobin Smith, I am Todd Schoenberger. We want to thank you once again for joining us today on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.